Hey everyone, over the past 20 years, I've walked the retirement journey with a lot of people from the point where they left their job for the last time all the way through to the later stages of retirement and even death in some cases. And over those years, I've observed that there are a few hidden expenses that will often catch retirees off guard. And if they aren't managed properly, they have the potential to put someone's financial security in jeopardy. Retirement is one of those times where every dollar counts, and your retirement income plan needs to anticipate a few of these expenses that can pop up. So today, I want to cover the 5 hidden expenses that I see most often in retirement. And first up is uncovered health care. Even with Medicare, healthcare costs can still add up in retirement, but a lot of retirees don't fully appreciate just how much these expenses can be because they think Medicare covers more than it actually does. The truth is that Part A and B Medicare only covers hospital stays and doctor's visits. A lot of the other things that you may be used to on a company-sponsored retirement plan, like dental, vision, hearing, and prescription drugs, those are only covered through supplemental plans, which cost extra. So for complete coverage that, again, you may have been used to when you were working, you may need to have multiple plans. So, for example, you can sign up for Medicare's standalone prescription drug program known as Part D, as well as purchase a private Medigap policy to cover deductibles, coinsurance, and copays. You could also add private insurance to cover dental, hearing, and vision care. And another approach would be to buy a Medicare Advantage plan, which bundles Part A and B, and it often includes dental, vision, and hearing. And I know those aren't easy choices, and there's a lot to think about when you're making these choices. So, for example, a Medigap plan may mean fewer out-of-pocket expenses, but generally have higher premiums. And Medicare Advantage, on the other hand, may have lower premiums, but they could certainly involve more out-of-pocket expenses. Altogether, it's probably reasonable to start with a budget between $400 and $800 per month per person for healthcare cost, and that amount can vary wildly. If you're trying to make these decisions about Medicare, I'd highly recommend using a reputable company to help you sort out all of your options. Not someone like me that kind of knows a little bit about Medicare and has an insurance license, right? You want someone who does this all the time and serves a lot of people. Someone like Boomer Benefits. And I'm sure there's other good companies out there, but I'm just familiar with Boomer Benefits, and there are thousands of positive reviews that you can find online speak for themselves. And another thing that you may want to consider if you still have time before retirement is contributing to a health savings account. You most often just refer to these as an HSA. Contributions to HSAs are federally tax deductible, and withdrawals are tax-free if they're used for qualified medical expenses, which include Medicare premiums and out-of-pocket costs, but not Medigap and Medicare Advantage premiums. You can keep these savings, invest them in that plan, and they won't have a drag from taxes because they're going to grow tax deferred. And then when you pull them out, as long as you use them again for healthcare costs, they're tax-free. Now, before we move on down to the comments, I do want to hear from those who have already retired. What's an expense that has taken you by surprise? I'd like you to tell us a little bit about it and how you handled it. The second hidden expense is unexpected housing cost. According to a study by Harvard, nearly 80% of people age 65 and older own their own home. And if you own a home now, you know that home ownership comes at a cost, and sometimes there are unexpected expenses. There was a piece of research from the Society of Actuaries that found unanticipated home repairs are retirees' single most common financial surprise. For example, in this part of the country at least, you'd be amazed at how often clients have to take big distributions to have their foundations leveled. So a good rule of thumb is to build into your retirement budget an annual expense that's equal to about 1% of your home's total value to cover those annual repairs and maintenance. That may be too much in most years, but then you're going to have those years where it's not enough. And if you average it out to about that 1%, that ought to keep you covered. The third expense is long-term care. According to the Department of Health and Human Services, close to 70% today's 65-year-olds are going to require some type of long-term care for an average of about 3 years. Now, that's a big expense, and those costs are increasing every year. For example, in 2022, the national average cost for in-home care was about $60,000. And if that turns into a private room in a nursing home, that's just over $100,000. Now, some people have a long-term care insurance to pay for some or all of this, but a lot of people who bought that coverage have let it lapse because the premiums just kept increasing as insurance companies realized they'd mispriced their coverage. Now, this is an expense that needs to be built into your retirement income plan. In the plans that we build for clients, we include 2 years of home care by default. And we simply take today's cost and increase that by a certain rate of inflation. And some clients, they'll want to see 3 or 4 years, and then some clients have coverage and they don't want to see anything in the plan at all. But the important thing is to recognize that this is an expense that you will likely have, and you need to have a plan to cover it. The fourth unexpected expense is grown children. There are really 2 versions of this expense. The first is the adult who just wants to keep mooching off their parents. And then we have the adult who hits a crisis point and needs someone to step in temporarily. Now, either of these can put your retirement savings at risk, and there are some similarities in how they need to be handled. The most important thing is that it's critical to have crystal clear communication. Don't be afraid to tell your kid how much help you're willing to give and what your expectations are for getting that money back. And there's nothing wrong with having it in writing. Otherwise, the payback method you tell them versus how they remember it can get distorted, and a loan turns into a gift. Then not only do you have the issue of putting your retirement savings in jeopardy, but now you potentially have your other kids getting upset and causing family drama. If you can avoid it, I'd highly recommend finding some alternatives to giving your kids money. They're adults. I've just seen too many cases where they have a real point of crisis and a parent steps in with money to help solve that crisis. But after that, the crisis starts to happen more frequently until they've eventually turned mom and dad into a line of credit that doesn't have any repayment terms. It's best just not to go down that road if you can avoid it. The fifth hidden surprise is the financial impact of losing a spouse. Now, there's little you can do to prepare for the emotional shock of losing a spouse, but failing to prepare for it financially can leave you in a really bad spot. But the good news is that there are steps you can take to mitigate that risk. The first thing you have to know is that when you're planning for a financial impact of losing a spouse, you have to know what that impact is going to be. For example, if you have a pension, what are the survivorship options? In most cases, the death of a person who earned the pension will result in some sort of reduction to the ongoing pension payments. And then what about Social Security? When one spouse dies, the only benefit that continues is the higher benefit. So if you have a couple who have very similar benefits, that means that their income from Social Security will drop in half. But all of this can and should be planned for. This type of testing should be integrated into your retirement plan, and it should be easy to check through the various ages and see what the impact will be if one spouse dies. And once you know the impact, then the contingency can be added into your plan. That way, if a spouse dies, there's already a plan in place. And that's the important part, that you have a plan. This is something that you should have in place before or at least shortly after you retire, and it should serve as your guide when things come up. And these plans should evolve too. So when something comes up, you can go back to your plan and ask the question, how will this affect the long-term plan? Now, if you don't have a plan, down in the description, I'm going to put a link where you can get in touch with me and my team to get a plan that's built, that's customized to your specific objectives. And also, down in the comments, I'd like to hear from you. Were there some of the hidden expenses in retirement that I've missed? And if so, what are they? Tell me about your experiences with those. Thank you so much for watching.